Welcome back, everyone, to Money and Markets. Recent economic weakness and uncertainty in the financial markets have sent yields on everything from treasuries to junk bonds to historic lows. So for this week's Picks and Pans, our producer, Jen Amos, asked all the Weiss research editors where they would put their money and which investments in the bond market they would just stay away from. Jen, so good to see you out here on the set.
And I'm back again.
Well, we're glad to have you. So what are the editors saying? What are you hearing from them?
Well, the consensus seems to be that investors should think long and hard before jumping on the bandwagon and following everyone else into treasuries. You and Steve were talking earlier about ETFs before the break. So let's look at the most actively traded bond fund, the iShares Barclays 20-plus year treasury. It's had a huge run over the past few months as bond prices have soared. And it yields about 3.6%, which may seem attractive compared to short-term rates near zero. But as ETF expert Ron Rowland points out, you'd have to hold this investment for 25 to 30 years to guarantee that total return. The fund is also highly vulnerable to rising interest rates. Listen to this. If rates rise just 1%, TLT will lose nearly 16% of its value. That's equal to more than 4 years' worth of interest. This is a perfect example of why treasuries are far from a safe investment right now.
And I would imagine if treasuries aren't even safe anymore, then junk bonds aren't the way to go either, right?
Right. Mike mentioned his opinion of high-yield debt earlier, and he told me about a couple specific investments he would stay away from in that arena. Both the iShares iBox High Yield Corporate Bond Fund and the Spider Barclays Capital High Yield Bond Fund have been on a tear since May, as investors desperately chase after yield. But in Mike's opinion, both of these ETFs have run too far, way too fast, especially if a double-dip recession is a significant risk. So he recommends that if you have any exposure to junk bonds, you should sell.
Okay, so what does he recommend that investors buy instead?
For his pick, Mike looked outside the U.S. bond market. The iShares S&P Citi 1 to 3 year International Treasury Bond ETF has rallied alongside similar funds, but it may be a safer play than either U.S. Treasuries or corporate debt. It holds 26 bonds in mainly developed nations such as Belgium, Spain, and Finland.
Jen, what about investors who want to stay away from bonds entirely and they want to take advantage of higher yields in other asset classes?
One way to do that is with dividend-paying stocks. Niles Mativ, the editor of Dividend Superstars, recommends conservative utilities such as Consolidated Edison. It pays out a quarterly dividend of 5%, and its underlying business requires big capital expenditures, so it benefits from borrowing at low rates. You can see how much Con Ed has enjoyed low interest rates just by looking at its performance over the past year. But of course, if bond prices start to go down again, these types of stocks may take a hit as well.
All right, Jen Amos, so good to see you out here on the set.
Thank you.
Coming up next, Mike Larson and Steve Chapman will be back to discuss their investment strategies for the bond markets. And they'll be joined by Monty Agrawal, who has 15 years of experience trading at Wall Street banks and hedge funds. Plus a closing comment from Martin Weiss when Money and Markets returns.